Hello everyone. Welcome back to another video from Excel Templates, where we will show you this new free options calculator. With this free template for Excel, you will be able to understand exactly how premiums work and which variables affect its price. Moreover, you can get instant Greeks values for a better understanding of your trades. Let's get started. Okay. First of all, you can see there are two sheets in this template. The black and skulls one refers to the formula discovered by this mathematician, who understood exactly which ones were the key variables affecting an options premium. The second one was a later version from Merton, who added the dividend yield a stock or ETF may have during the lifetime of the options contract. Now that we have covered the basics for this options calculator, let's dive into it. First of all, you need to set all of these parameters. The stock price, also known in the options world as the underlying price. The strike price for your options contract. For example, let's suppose we think Apple is going to move higher in the next weeks. Therefore, we have two possibilities. Either buy a call or sell a put. If what we want is to go long on the call, we can buy a 155 call, which will give us money as soon as the underlying stock rises above 155. But if what we want is trade something more favorable to our position, we can trade a 150 call, which is already ITM and has a major probability of success. Now that we have decided which strike price we want to focus, the next step is to type the volatility. You can see this value normally on all your platform tools such as Yahoo Finance or any other trading platform. Be aware that the implied volatility is not the same for the underlying stock than for the specific strike price. After you have set the rest of the parameters, you can come back to the fourth and play with it in order to see what would happen to the options premium given a specific rise or fall in volatility. The next two values are to determine how much time left the options contract has. The longer the lifetime value, the higher the premium. Both for the calls and puts. The risk-free rate doesn't affect too much to the options premium but is an important factor to understand. It is the rate at which a trader can invest in fixed income such as treasured bonds without incurring in any risk. The higher the risk-free rate the Fed has, the bigger the number of traders who would prefer to move to fixed income contracts. This creates a need on the options premium to give at least a bigger rate of return than the risk-free rate if it wants to attract investors. The last parameter, just available in the Merton formula, is the dividend yield expressed as a percentage. For example, imagine Apple is going to give a 2% dividend the 10th of September. This case affects us, because our options contract lifetime value is between this date. As a result, call options will decrease their values, likewise put contracts, which will benefit from it. This is because on efficient market conditions, if a company is going to give away 2% of their earnings, then the stock should reflect that immediately by a decrease of exactly 2% on the stock price. Now that we have covered all the parameters and their meanings, it's time for you to play with them with this free options template for Excel just available on our store. Link in the description. Please don't hesitate giving us your comments on any thoughts about it, and see you on the next video.